Hey, I'm Jason, and this is Supply and Demand Shorts. I'm going to go through what we learned about the economy today, and I'm going to try to get through it in about 2.5 minutes. So let's get going. The U.S. manufacturing indices are down a little bit. The construction spending in the United States is up a little bit, and the EU is moving forward with a full embargo on Russian oil. So the manufacturing indices, we've got a level for April of 2022 of 59.2%. That's in comparison to March of 2022 where we had 59.7%. Now that's basically a rounding error. So if I'm looking at this data, I'm not incredibly concerned about it. From the Institute for Supply Management, on the other hand, that's another institution that collects this data and publishes this statistic. We got 57.1% in March of 2022, and it's down in April to 55.4%. So that one is a little bit more concerning, and I'd say a little bit more than a rounding error. Construction spending is up a little bit on a monthly basis, but the rate of increase has certainly dropped. I would call 0.1% something akin to a rounding error. I don't know. And that's in comparison to February of 2022, where that rate of increase was 0.5%. So a good 0.5% versus a tenth of a percent. On an annual basis, though, so that's March 2021 to March of 2022, actually construction spending is up about 11.8%, which is a pretty significant jump even comparison to history. And we're going to talk a little bit more about the construction spending on the YouTube video because there's a way different angle to look at this. The EU's oil embargo looks like they want to ban crude oil by the mid to end of this year. So we're talking from the Wall Street Journal article. I gathered it was about September to October maybe. And then they want to ban oil derivatives completely. Oil derivatives refined in Russia, that's your jet fuel and your petroleum. They want to ban those by the very end of 2022. And it looks like they're going to give Slovakia and Hungary a little bit of extra time to prepare because of their particular exposure to Russian oil imports. And lastly, the German economic minister had something very interesting to say. Moving away from cheap Russian energy means a permanent increase in prices for German consumers and industry. This is the bitter and harsh reality. The era of cheap energy is over. Now, I'm going to talk a little bit more about that again on YouTube, and if you would like to join me and want to understand those statistics that I mentioned just a little bit better and how they relate to everything, again, hit the link here or here. I don't know where I'm going to put it, but go ahead and hit the link, and I will see you on YouTube. Thanks for joining. Have a good night. All right, me again. Yep, still me. So now we're going to take a moment to, well, actually several minutes, not just a moment. And I'm going to go into a little bit more detail about the economic statistics that were released today and that were covered in the daily note prior. A little bit about how they're calculated and what they mean. So I'm going to share some materials here, and this is the Supply and Demand Daily, the details. Name is still up for debate. Okay, so the first thing that I looked at was the Manufacturing Purchasing Managers Index, otherwise known as the PMI. So if you go online and you're looking at economic indicators, as only nerds do probably, I guess, but what you're going to see is not exactly what I titled my page, but it's just going to probably say Manufacturing PMI. And then on other days, maybe tomorrow, actually, I forget exactly when it comes out, but on other days you'll see a services PMI, which is slightly different, but it follows the same concept, the same formulation. So, and the most watched variants of those are going to be the S&P 500's manufacturing PMI. That was originally done by IHS Markit, and then S&P bought IHS, so now it's the S&P Global U.S. Manufacturing PMI. And then the other one is the one that's released by the Institute for Supply Management, or the ISM, and that's probably the most tracked, the most common, and I guess maybe you consider the most reliable. I'm not sure. Like I said, they follow the same similar methodology. It's it's mostly the same. It's just maybe the weightings of certain components are a little different. So the way that these things are generated is that the survey, the data managing company, so whether that's S&P Global or whether it's ISM, but let's just stick with ISM. Again, that's the Institute for Supply Management. So what they're going to do is every month they send out a survey to a sample of business leaders, a sample of businesses that are in the manufacturing business. And if they were doing this for the services PMI, then they would survey services businesses. So that's a little bit different there. And they're going to survey them and ask questions about a host of different factors related specifically to their operations. So the way that you can look at this is kind of like a doctor taking a physical. They're going to check your pulse. They're going to listen to your lungs. They're going to, I guess they look at your belly button to make sure you don't have a hernia. And they take your height, your weight, your blood pressure, maybe your body mass index. I don't know. It's been a while since I've been to a doctor. But they're kind of going to do that on a big sample of manufacturing companies. And this is the stuff that they look at. Well, to review the data, I guess we can go back to this. But the factors that they're going to look at are new orders, which is how much stuff are you bringing in to make more stuff. They're going to look at output, which is the amount of stuff that came off of your production lines. They'll look at employment, which is basically are you hiring or are you not hiring. The delivery times that suppliers take to get them materials so that they can turn stuff into more stuff, and then the stocks of materials that they have on hand. So I don't know if you're in the business of making some kind of plastic things like maybe storage bins, then that input would be the amount of plastic pellets that you have on hand, among other things. It wouldn't just be that. I mean, I'm sure there's all kinds of other stuff that goes into the production. You probably need some spare parts for your machines and all kinds of stuff like that. So you take a survey, you ask questions about those factors, and then moving on, what do you do with it? Well, you build an index for each factor. And all the index is, and this is what kind of makes the PMIs very intuitive, all the index is it's going to be the percentage of the respondents who answer in the positive, in addition to the percentage of the respondents who answer in basically in the unchanged. So you're looking for not exact quantities. Like you're not going to ask these people, how much more of this good did you produce? You're looking for, did it go up or did it go down? You're not looking for how many employees did you add. You're looking for, or subtract, you're looking for, did the amount of employees you have on your payroll go up or did it go down? So for example, we're going to do a, por ejemplo, for example, in Spanish to, I guess if you took 8th grade Spanish, you probably know that, or even 6th grade Spanish. I didn't do very well in foreign language classes, but anyway, so you survey one, for example, so you're going to take the hiring component. That's what we're going to use as an example here. And you're going to survey 100 manufacturing companies, and all you're going to ask them is, how has your payroll changed since last month? Again, not looking for specific numbers, just did it go up or did it go down? And let's say that 50% of those respondents say that the payroll has increased. That means that they've hired people. And 25% say that the payroll has stayed the same. So they haven't laid anybody off, but they haven't hired anybody new. And so what value is that going to give you? Well, you take the percentage saying yes to the percentage saying unchanged. That's 50 plus 25 out of 100, and you get 75%. The implication here is that if your payroll has not increased and your payroll has not stayed the same, then it has decreased. So you don't really need to take that into account. What you get out of this is the share of purchasing managers in the manufacturing field who are reporting that they have increased their payrolls. And so this is why the PMIs are really good for taking the pulse on the pace of industry. So you get 75 there. Now, let's take this and see how we would combine it with the other indices to produce the headline PMI, which, again, is the result of, 5 factors, 6 factors? I think it's 5. Yep, 5 factors. So we're going to take that hiring PMI index, which is 75%, and we're going to weight it. And whenever you weight something in an average, that means that you assign different levels of importance. So hiring is pretty important, and the ISM agrees with that as well. So hiring has, I think, a 30% weight in the index, whereas the delivery times of suppliers, for example, that element of the index, that has a weighting of, I believe, 10%. It might be 15, but it's below 20. Yeah, it's 10 or 15%. So that has a lower weighting. And so you're just going to take this index, imagine that we did the same thing for all the other factors, the supply deliveries, the inventories of inputs on hand, the stocks of inputs and all that stuff, the output that's coming off of our production lines. We take the PMIs that we calculated for all of those and we weight them and we put them together. And then that's how you get the headline PMI. Now, the way to read this is that below 50 historically means that the economy is shrinking, or at least that the manufacturing industry is shrinking. And if this were the services PMI, then it would indicate that the service industry is shrinking. And to kind of get an idea of why that is, well, just think about it. So if you have a level that's below 50, essentially that means that the majority of the respondents that you have surveyed are not expanding their operations. So it's very intuitive that way. PMI is a relatively good indicator. And the good news is it comes out very fast. It's basically the first business day of the month. You find out what the PMI was for the last month. So that's not bad. Now let's move on to construction spending. This is a really interesting thing because if we look at the raw data from the Census Bureau, first consideration is the Census Bureau is lagged by 2 months whenever they release this. So if you're sitting in May and you get the data, then you're not looking at April and you're certainly not looking at May, but you're looking at March. So that's kind of that's a weakness all on its own. But the other thing about it to remember is that it's not adjusted for prices. And the prices that affect construction are very different from the prices that affect you and me when we go to the grocery store or we go to get a drink at the bar or we go to a restaurant or a movie or whatever. The prices that affect construction, the construction industry, are much more tied to base commodities. We're talking about lumber, masonry, so stone, everything that goes into that, especially energy, because it takes a quite large amount of energy to produce all of those things to get them ready to go into a house or an apartment complex or maybe an office building, stuff like that. So steel prices, iron prices, nickel, copper that goes into the wire for those buildings. The construction industry is much more sensitive to these types of prices than they are to the prices of bread, eggs, movie tickets, all that kind of stuff. And so when we look at this data on a non-inflation adjusted or price adjusted picture, however you want to say it, we see that the annual change is really high in the upward direction. So it's 11.8% on a yearly basis from March 2021 to March 2022. That looks really good. And even on a monthly basis, I mean, if you take the 0.1% and you multiply, and it does that every month for a year, which it doesn't. If you look at a monthly chart, it's very zigzaggy. It's very volatile. But let's say that, even the average is 0.5%. Well, you're still getting 6% year-on-year growth, which is much more than we've seen, in real gross domestic product or like a big economy-wide indicator in a while, with the exception of the last quarter of 2021. But a lot of that is because the economy was so bad 4 quarters before that. So, but anyway, I'm getting off track here. So, when we look at these figures on a nominal basis, whenever you hear the word nominal in economics, that simply means that it is recorded as the price at the time. So if I bought a Coke for 50 cents in 1982, then the nominal price of that Coke was 50 cents. Now, the real price of that Coke would depend on which year I made the comparison year. So in 2019 dollars, that might be $2. I don't know. In 1974 dollars, it might be 35 cents. I don't know. Just depends on how you measure it there. And so I'm going to show a chart that just shows the absolute level of construction spending over time since this metric started to be recorded by the Census Bureau in 1992. And if you look at a chart like that, we see leading up to the great financial crisis when there was obviously maybe not obviously, leading up to the great financial crisis, there was a residential building boom. And that's why we see this big spike here between between 2004 and 2006. And right around 2006, in I believe it was the month of June, is when that starts to fall off, because that's when the home building industry started to see a really big correction, and it never really recovered going all the way into 2012. And then it started to build that slope again, and we're still riding that happy wave upward, as you can see by this chart. Now, that's all well and good, but I thought it would be a lot more interesting and maybe realistic to look at this adjusted for prices. And the reason that I think it's important to do this is because, let's say that you're buying bricks to use as an input to build a house. Now, increasing the supply of housing is on net good for the economy. When there are more houses built or more apartments built, then it makes everybody better off, because what does it do? It's going to drive down the relative price of housing for everybody. At least people in that geographic area. And so when we're collecting national statistics, we kind of assume that general trend is true across all geographic areas. And a lot of times it can be. So anyway, when we look at numbers like this, we're really interested in indicators that show that the standard of living of the economy as a whole, people in the economy as a whole, is what I mean by that. You, me, dogs, I guess, and kids and grandmothers and everybody. So what we're looking for is to determine, is our standard of living going up or is it going down? Now, if the purchasers of manufactured goods that are going into housing, so base materials, so let's just say bricks, a lot of houses have bricks, right? So let's say that in 2019, the price of one brick is maybe 25 cents, and there were $1,000 worth of those bricks purchased. So if you do the math, that's 4,000 bricks. Now, let's say that 2 years later, the price of bricks has doubled, right? So the price of bricks has doubled, and so it's 50 cents a brick, and the spending on bricks has also doubled. And so you still get 4,000 bricks, you spend $2,000, you get 4,000 bricks, but the problem is, if you think about it, the amount of dollar spending has gone up. The amount of dollar spending has gone up by a factor of 2. You were spending $1,000, and now you're spending $2,000. But how much standard of living improvement are we getting out of that $2,000? The same amount. So that will register as growth on this chart here. What I just described, that would register as a high rate of growth. That would be, that would be 50% in spending terms. That would be 50% a year for 2 years to get it to double. But what's going on behind the scenes is that actually there isn't much standard of living being added to the system as a whole. And so that's why it's important to adjust these numbers for prices. And which prices are we going to use? Well, it goes back to what I was saying earlier about how the construction industry is particularly sensitive to base commodities like lumber, like steel, iron, energy, all that good stuff. Because it takes a lot of fuel to run saws, takes a lot of fuel to turn clay, dirt clay into bricks and to ship them. And it just takes a lot of energy to do these things. It takes a lot of energy to build any structure. And so it's important to use an appropriate price index. So that's why you wouldn't use the consumer price index, which is a statistic that tracks the rate of change in a basket of consumer goods, like we were saying, bread, eggs, movie tickets, cars, used cars, all that kind of stuff. We use another measure called the purchasing excuse me, what is it called? The producer price index. Yeah, that's it. So the Fed has been actually tracking a producer price index, or maybe it's it's actually the Bureau of Labor Statistics. But anyway, they've been tracking one since the early 1920s. So we do have a producer price index that goes all the way back then, and it is specifically a producer price index that tracks a group of commodities that are used in industries like construction. And so if we take these numbers and we basically adjust the data, so I took the data and I adjusted it to where basically the whole data series would be in 2019 prices. So as if all of the purchasing that produced these readings had been done in 2019, and we get a chart that looks more like this. So couple things to jump out at you. This is the end of the building boom in 2008. And if we adjust our data for the increase in commodity prices, again, these are the prices that the construction industry is particularly sensitive to, we're actually not far beyond that level, or we were not actually that far beyond that particular level of 2006. That's when the housing market turned around. 2006 spending in late 2019, and now we're actually below it. So for every dollar, that means that for every dollar that is spent in construction, that's actually bringing less stuff, less standard of living, less housing, less office building pieces, pieces and parts to the marketplace for consumers to use and consumers to buy, live in, use as a workspace than they were in 2006 and they were in 2019. So it's, again, very important to take these numbers and take them with a grain of salt, but also to adjust them for changes in prices, because prices are changing all the time, and the price that was paid for something at any given moment is not necessarily a reflection of the value of that thing. And so I thought that was very interesting and wanted to share with the audience here, because essentially what that means is, for all of these rising home prices that we've seen in the last 2 years since the beginning of the pandemic, there hasn't really been an uptick in the amount of housing available, and it doesn't really look like there's going to be, because this downward trend here has existed for 2 years. And so, at least on a construction basis, on a structural basis, has the standard of living for all of this paper economic growth and all of the demand and all of the deposits that have been added to consumers' bank accounts, is the standard of living really going up? And this is one chart that indicates not a whole lot. And this is one chart that directly relates to something that's very important, which is how much is available for people to live in, how many structures are available for people to live in. So, and then the last thing, I'm just going to make a couple notes on the German EU energy situation. So the one thing that I wanted to point out about some of these quotes, this is the German foreign minister. She says, this is from a Wall Street Journal article, "We're also pushing within the EU to now phase out oil altogether as Europe in the EU's sixth sanction package." As Europe and the EU, I think that's what that means, sixth sanctions package. She also said that the EU's sweeping economic sanctions on Russia should remain in place until Russian troops withdraw completely from Ukraine. Now, that article explains that it's going to take at least several months, at least 7 months between now and the end of 2022 to completely enforce an embargo on Russian oil. So if I were Germans and if I were Americans, which I am, believe it or not, I would be very concerned about that type of language, because the country that is one skip between Russia and Ukraine, or not between, but one skip after Russia to Ukraine to Germany, is basically planning for a long, drawn-out conflict And they are willing to pursue all of these logistical hangups, all of these massive logistical overhauls that it's going to take them in order to embargo Russian oil completely. And so to me, that indicates that the German government is not planning on peace and they're not interested in pursuing peace. And the United States government is talking the same language. Now I'm going to move down to Robert Hayback. I think I mentioned this in the quick version of the Daily Note, but this quote just really jumped out at me as honestly just not cool. Moving away from cheap Russian energy means a permanent increase in prices for German consumers and industry. This is the German economic minister who is supposed to be, if you think about economy, it's trade in goods and services. And why are goods and services traded? Because they make the traders of those goods and services better off. I go to the grocery store to buy bread ready-made because I'd rather do that than spend the time to make it myself. And so this is the basis for all economic interaction. And the German economy minister, as the name would suggest, well, I would say his job is to look out for the well-being of the citizens of Germany. But instead, because of this invasion and because of I mentioned this on Friday, and I know this is strong language, but global political posturing that's going on around this whole thing, the German economic minister, Robert Hayback, is completely foregoing the well-being of Germans in favor of, again, this political posturing, this move, this desire to look like we're doing something, as if this is going to stop Ukrainians from dying, or as if this is going to stop the war. If anything, it's probably going to prolong the war. But anyway, so he says moving away from cheap Russian energy means a permanent increase in prices for German consumers and industry. This is the bitter and harsh reality. So you better be ready to take it. The era of cheap energy is over. And I just find that interesting because it's not like the era of cheap energy ended itself. I mean, oil prices have been going up for, a year and a half? And that was after they had been historically low for the better part of a decade. Before this, Germany was pursuing wind and solar energy on the logical basis that it eventually would be cheaper. That's what the people who were in favor of those policies of subsidizing renewables have always said, is that, well, on a net basis, it's cheaper. And you can find PhDs who will do all these calculations to show that, wind and solar are in fact cheaper and whatnot. Without getting too much into that, this is a complete 180. We are planning on the war lasting until we can pursue these sanctions, until we can fully enforce these sanctions. And I would say the acid test here, as far as whether or not this was ever really about Ukraine, is that if Russia and Ukraine do manage to broker a ceasefire, or if they retreat to their ends of the field, if Russia stays in the east in Donbass and the Ukrainians agree to stay on, their side, I guess they do consider both sides to be their side, without getting too much into that, if there is a ceasefire and these sanctions are not lifted, I think we'll know definitively that this was never actually about Ukraine. So something to keep in mind for the rest of 2022, and I will keep providing updates on this story as it goes on. That's all the time I have for right now. Thank you very much for spending your 25 minutes to talk about these topics with me. If you have some feedback for how these can be done better, please let me know. You can leave me a comment. You can message me on YouTube. If that's even you can leave a YouTube comment or a comment on Instagram or send a DM on Instagram, whatever you want to do. But again, I do appreciate your time, and I hope that this has been educational and informative. I'll see you tomorrow for the Supply and Demand Daily, May 3rd, 2022. Catch you later. Have a good night.